I'm Dr. Cheryl Dunn, and I'm here to demonstrate an introductory financial accounting problem in which we are asked to prepare a month-end bank reconciliation. As you know, a bank reconciliation is a resolution or an explanation of the difference between a company's bank statement balance, how much the bank says they have in cash on a certain date, and how much their general ledger balance says they have on that same date. The two balances most often are different, and most often they're both incorrect because both parties knew about some things that the other party did not know about. So take a look at the problem. Okay, the first step in making a bank reconciliation is to put the company name at the top, in this case BYE, and then we say what it is we are creating, which in this case is a bank reconciliation. And the date of this reconciliation is December 31st. We then start by writing the bank balance. We can either write it at the top and then partway down we can write the company's balance and go from there. So we can do a top and bottom presentation of our reconciliation. Or what I like to do instead is do a left and right. By doing left and right, I don't have to worry about how much space to leave in between the bank balance and the book balance. And I can just work on both sides as I come to things that affect them. So we're going to start with the bank balance, which is given to us as $19,240. And then we're going to write our book balance, which is given to us as $18,510. Next, we're going to look at each of the items that are lettered A through H and ask ourselves whether they affect the bank balance or whether they affect the book balance. The first one we come to, letter A, is an example of an automatic bill payment. So companies oftentimes will have agreements with their service providers that the service provider can automatically withdraw the amount of their bill each month from their bank statement instead of writing a check and sending it to them in the mail. And oftentimes the service provider will provide some kind of an electronic notification to the company as to the amount. But sometimes the companies don't record them when they get those electronic notifications. They just say, oh yeah, that amount seems like it's reasonable or it's okay. And then when they get the bank statement, that's when they actually record the check written, electronic check. It's not a physical check, but the electronic check that got written out of their account. And that's what's happened in this case. So the company paid its telephone bill of $520, but instead of writing a check when they got the bill in the mail, instead they got the bill and they said it would be automatically withdrawn from their account, and so they didn't make any entry at that time. Instead, they just waited for the bank statement to arrive. They could have made an entry at the time. This company didn't. And so now that they get their statement, they have to subtract that automatic bill payment, which in this case was $520. Letter B is an example of a deposit in transit. A deposit in transit is a deposit that the company has made, but it has not yet cleared the bank statement. So the bank has not put it on its statement. That means it's not reflected in this bank balance, and yet it is something that should be. It's something the company knew about before the bank knew about it. And so the bank hasn't put it in its records. The book balance does reflect it in its record. So we're going to write deposit in transit. And this is going to increase the bank balance. In this case, the amount of that deposit is $2,215. So we add that to the bank balance. Letter C is an example of outstanding checks. In this case, there are two outstanding checks. These are checks that the company has written. They're accounted for in the company balance, but they haven't yet cleared the bank, so they haven't appeared on the bank statement yet, which means they have not been deducted from that bank's balance. And so outstanding checks get subtracted from the bank's balance. in this case, the two outstanding checks total $4,530. So we subtract that from the bank balance. Okay, letter D is an example of an erroneous check. So the company wrote the check for $12,000 and the bank correctly cashed it for $12,000. Unfortunately, when the company recorded the check in its system, instead of recording it for the $12,000 that they wrote it for, they only recorded it for $10,200. So they would have debited the expense account for $10,200 instead of $12,000, and they would have credited the cash account for $10,200 instead of $12,000. So at this point, their cash account is overstated by the difference between $12,000 and $10,200. That difference is $1,800. And so we need to subtract the error in that check, which is number 15,312, and that error is for $1,800. We need to subtract that from the book balance that we have so far reported. Letter E describes an NSF check. NSF stands for non-sufficient funds. In other words, this check is a check that bounced. The company deposited this $1,500 check as part of its deposits. It would have recorded it as an increase in cash, so that would be reflected in this book balance here. And yet when they presented it to the bank for deposit, the bank started to process it and then realized, oh, this isn't actually cash. This is a worthless piece of paper. There are no funds, not enough funds in this customer's account to cover the check that they have written. And so the bank did not include it in the bank balance. Instead, it returned it saying, this is a no good piece of paper. Try again later. And so what the company now has to do is subtract that NSF check because it shouldn't have been reflected in that balance because it wasn't actually cash. Now that doesn't mean they're just going to give up on getting that customer's money. They're going to subtract it for now from their balance, but then they're going to begin collection procedures to try to collect that money from the customer because the customer does owe that money. Okay, so we subtract the NSF check for $1,500 from the book balance. Okay, letter F records the interest that was earned on the checking account for the month of December, and it tells us that that was $215. That would be something that company might have known that they were going to earn interest on their checking account, but they wouldn't have known the amount ahead of time. And so they wait for the bank statement to come, and they use that as if it were a source document telling them the interest that they've earned. The bank would already have reflected that interest earned in the company's account balance with them. So we don't need to adjust the bank balance. We do need to adjust the books balance because they would not have recorded that in their general ledger yet. It's not reflected there. So we're going to add the interest earned for $215. Okay, letter G is the collection of a note receivable that the bank has made on behalf of the company. In other words, whoever owed the company the money from the note paid the bank directly, deposited into the company's account with the bank, rather than writing the company a check and then the company having to take the check to the bank to cash it or to deposit into their account. It was automatically deposited on their behalf. And in this case, they have not only the note payment, but also the interest that went along with it. And so they're going to record two things. They're going to record the collection of the note, which will then decrease the receivable on the company's books, and that was for $2,000. And then they're also going to record more interest earned. In this case, it was interest earned on the note as opposed to interest being earned on the checking account. Both of them are interest earned. There's going to credit interest revenue for both of them. We're going to list it separately because this is interest earned on the checking account. This is interest earned on collection of the note. And in this case, it was $50. Okay, letter H describes a bank service fee. A bank service fee is something the bank knew about because the bank is charging that amount to the company. The company didn't know about, they may have known they were going to have a fee, but they didn't know how much the fee was until they received the bank statement. And so now, based on receiving the bank statement, they're going to record that service fee expense, and that would be a reduction in their cash balance, in this case, for $30. Okay, if we then sum both sides here, we're going to see that 19,240 plus 2,215 minus 4,530 is going to give us $16,925. If we go over here and we take $18,510 minus 520 minus 1,800 minus 1,500 plus 215 plus 2,000 plus 50 minus 30, we're also going to end up with $16,925. So when we reach the end here, we will see that the adjusted balance on both sides is equal, which means we can be fairly confident that we have arrived at the true cash balance on December 31st for the BYE company. Thank you for viewing this demonstration, and I hope you found it helpful.